let's do a podcast. We're going to do episode 581, Tech Turf War. I love Matt's titles. It's a great title because it talks about something that maybe you're not aware of, that is a developing story out there in the market. We're going to talk about software versus semiconductors. One area doing pretty decent, the other lowering guidance. We're going to talk about what that means. We're going to talk about a very interesting candle on Friday, a very interesting couple weeks coming up ahead of us, and break it all down. Matt, happy to be with you on this podcast as always. How are you doing?
Doing good. Excited to be with you as well for another edition of the podcast 581. And I was thinking about the themes that are really kind of rocking in the market right now, and as the market is a little bit mixed. And one of the open questions we had over the last couple weeks, really kind of 2-3 weeks, is technology. Is the tech trade back? Is the tech trade going to lead the market in terms of this potential breakout? And when you're looking at that mixed market right now, and you're looking at a mixed technical situation, and you got a lot of opinions being played out in the market right now because there really isn't a united theme. I think out of every conversation in the market from a sector industry perspective, I'm not sure there's anything in the market that represents that conversation, the mixed market, the different, opinions out there in the market, and the random volatility, unlike other than technology, and specifically when you're looking at software components versus the semiconductors out there. Semiconductors in both of these two industries, software versus semi, they're both, the two biggest parts of the technology conversation. They're both part of that growth conversation when it comes to the potential of AI. And semiconductors are obviously leading that AI charge. They're kind of the front runners there. Software components are secondary analysis, more of a indirect impact right now. And so you're having some separation here. And so I felt like, a little bit of a discussion on this semis versus the software components, because I truly do believe whoever wins that battle is probably going to end up winning that tug and war in the markets right now.
Yeah. No, you didn't ask me how I was doing.
How you doing, by the way?
Listen, and I'm sensitive to this because my lovely wife, who's from France, hence the French and American flags behind me, was like, you Americans, you ask how you're doing, but you don't care. You don't care. You're being fake.
We do. We do care. We do care. We do care. And to your lovely wife, who is an amazing individual, I care very much. And so I apologize, Chucky. How you doing, brother?
So I just like, I'm like trying to, bring social conscious awareness to our pleasantries there. All that. Matt, let's talk about the technicals a little bit before we get into this bigger picture theme. One of the stories of the week happened in like the last hour of the market, where you're under pressure, you're breaking moving averages, you're starting to have conversations amongst traders of like, all right, maybe we don't revisit the recent lows, maybe we form a higher low. Those kind of conversations are naturally happening. They were happening between me and Frank on the halftime report on Friday. And then boom, much different look than maybe one might have thought in the technicals based on the close. Talk about that Friday candle and talk about where we're at from a technical perspective, because it's a very important conversation right now.
We were sitting in the scouting report meeting on Friday, and it was about 2 hours before the stock market was closing. And at that point, about 2 hours before the stock market was closing, the market was showing some downward pressure in price, pretty aggressive downward pressure in price on Friday. And that was following a slight fading price action in the major markets on Wednesday, Thursday, as the market was coming down a little bit. And then on Friday, you had a response to what I would describe as a technical response to the PCE report, as well as some negative information coming out in the technology space regarding some of those software components we are going to discuss here. I think you had this self first, ask questions later type mentality coming into the open on Friday. And so we were discussing the overall rankings of tackle trading as we put into the tackle trading newsletter every single weekend, whether or not we're going to maintain the 30 ranking in the S&P 500, or whether, which is a slightly bullish ranking for us, or whether the volatility and the downward movement in price this week was going to be justifiable to have that to have a downgrade in the market. And it was a fascinating conversation with a lot of opinion back and forth. Not to suggest one coach wanted to downgrade really aggressively and another coach wanted to.
Yeah, no, it was not a heated debate. We were just openly just like, oh, okay, let's talk this through, right?
The pros and cons, right?
Yeah, let's talk this through.
Pro, here's a con. And I think in general, most of us felt that, given the fact that you were seeing a little bit more downward pressure in price, a little bit more deeper pullbacks at the moment, that and the market was setting, at the low of the day at that point, and basically we all felt like the support levels the market was currently at were going to hold, but that we had to downgrade to respect the volatility. And so it was one of these weird moments where we're going back and forth for about 45 minutes. And it was a fascinating conversation. What's going on here? What's going on there? Let's look at the different spaces. Let's look at the volatility. Let's track the pullback. Let's, anchor against these support levels. And at the end of that, I remember drawing a Fibonacci on the NASDAQ, because the NASDAQ is really kind of where a lot of that volatility and conversation was centering around.
In fact, Matt, markets are so sensitive these days. Goldman Sachs, within the last 12 hours of this time period we're talking about, had put out why is the tech trade under pressure, and doing all that. That's what people were talking about over that 36-hour period.
Well, it's outside of some software components, there was okay, why are we seeing this much volatility, this much selling behavior? It didn't make a lot of sense given the fact that the PCE report kind of came in line and nothing really changed that conversation. And so it was fascinating as we were debating that downgrade, because we were at support. All of us kind of felt like support was going to hold, but we all respect volatility in the moment. And so all of a sudden I drew that Fibonacci and I said, guys, listen, we're sitting at the 50-period moving average. We're right in a Goldilocks retracement. I'm not sure we can downgrade given the fact that you haven't broke trend pattern and you just hit support. And then all of a sudden, an hour later, not kidding, we made the decision to basically punt to wait on the close to see if that support level was going to hold. And Mark, not only did it hold, it blew back up off that support level, little bit of a V-shaped recovery on the intraday analysis. And what I think really was the kicker in us maintaining the 30 ranking and understanding that support build was, not only did the 50-period moving average hold, not only did support hold, you also had increasing volume that dwarfed every other volume bar we've seen in the last couple months, quite frankly. And you had massive participation coming off that support level. And so as you started seeing this increase in participation, and as you started seeing the support levels hold, you then had a news story that came out that the Israelis were basically presenting a ceasefire plan to in that Israeli-Hamas conflict. That was a three-part plan of how they can get towards the end of that war. And so you had this news story come out that was obviously a very big positive. If you can remove one of the geopolitical situations that is happening from around the world, you're going to see that as a positive situation. And so you had support start building. You started seeing increasing participation on the intraday chart. And then you had a news story that we don't know if it's going to come to some degree of confirmation, but you did have that to add a little bit of an additional tailwind to the price action on Friday. And what that did is it not only staved off a downgrade in the market, it cleaned up the market a little bit as well, and really gave those bears a little bit of a present going into a weekend to make them think about some of their life choices. But it was a fascinating close on Friday. Now, The ultimate
I literally was chuckling and laughing while we were talking in that last 45 minutes.
It was amazing to watch as those bulls came back with such strength. There's no doubt about it. But the ultimate question is, what does it mean for the future? Because it's impressive to see it hold. It's obviously good for ongoing bullish positions. It's good for long-term investments and all that, but it's only one day within broad range neutrality, not broad range neutrality, but a little bit of consolidation here. And in my estimation, it's a step in the right direction, but it's not that final step. This is still consolidating. You still got volatility here. Coach Greg wrote about straddles and strangles in the traders report this weekend. And so you certainly like it. You certainly think it's a step in the right direction. You're certainly speaking as a bull. You certainly like to see the participation come back. And the last point on two further points on the technical conversation before I talk about kind of that ultimate conclusion of this saga. But in terms of the last 2 points, number one is RSI. For about a month now, we've been talking about an overextended condition going into the multiple time frame breakout against the all-time high. That's a tall ask when you're overextended going into a breakout. And I give the analogy all the time. When you're running too far going into a breakout, what you're asking it to do is run the exact same time, but now you're tired and you don't have the same degree of buyers coming back in. But if you can reset that distance you're running into that breakout, what's going to happen is you have fresher legs, you have more buyers, and you have a higher probability of seeing the market break out and truly run. And that can be achieved in one of two ways. Either market pulls back and thus gives up and alleviates the overextended conversation, or two, the market consolidates. And what happens as the market consolidates, yeah, you can just say it's taking a break, but what happens is remember, the calculation on RSI is 14 periods. And so as you can consolidate in 8, 9, 10, 11 trading sessions, all of a sudden these big upward movements in price that were in the part of the calculation, that now fades off as the calculation goes, and it brings RSI down because it gives a little bit more credibility and consistency to the consolidation than it did the previous upward movement in price. And so you can have RSI alleviate that consolidation one of two ways. And in my estimation, you kind of had a little bit of a combination of both. But now that brought RSI down underneath that 70. We're no longer overextended in the market. And so what the positive thing there is, as we do navigate that all-important zone of 5350, which is the intraday zone on the resistance level, which would confirm that multiple time frame breakout, you're not going to be overextended going into that versus if we would have broke out a week ago.
And this is a really important principle to understand.
Vitally important.
It is as far as the timing of things. People, you see all the time out there, like pundits and people scoff, you can't time the market while trying. Well, usually they're trying to sell you something when they're saying that.
They're trying to sell you a stock long term. Yes,
they're like, well, you can't time the market, so just come buy my mutual fund because but like in timing the market, which is essentially what technical analysis is, this is a very important learning point. I just want to emphasize it for a second, that when you're heading into a breakout and you are overextended, that makes the job extremely difficult.
Yeah.
Your chances of succeeding and extending that, boy, you better have a world-class catalyst behind you, right? Like some dogs and cats marrying each other, world peace, the end of inflation, something. Yeah. Otherwise.
Well, you're also asking the participants who did not participate in the run-up to now carry the next leg, and they weren't participating in the first place. That's a big ask.
Yeah. And so so understanding what Matt is saying here about, hey, listen, a little bit better situation if we run up this week or next into that resistance area for sustainability. Matt, one of the great calls that we have had on this podcast in the face of rising prices, and this goes back on this podcast to the start of March, where it maybe even the end of February,
Yeah.
where we're like, we smelled a consolidation period. We smelled a consolidation. That's where our analysis led to. You and I were both on the same page. That's exactly how this little time period has played out. And, in a lot of areas of the market, like, the Dow Jones, which has stole a lot of headlines a little bit, much deeper sell-off, quite dramatically, actually, for a little bit. You and I were talking, I don't know if it was Thursday or Friday, but we're like, this is just another version of consolidation. Consolidation can look it can have different looks. It doesn't always mean very tight ranges just hanging out, doesn't it?
No, it doesn't. You have and I've written about that multiple times in the newsletter in the last couple of weeks, as we have seen some general consolidation. But think about it, for example, a high base, which is a momentum technical pattern at the top end of a trend that has 3, 4, 5 days of consolidation, is a consolidation pattern. But it's not wide range. It's just simple consolidation where you don't want to see too much volatility. You just basically want to see everybody that's participating in that stock to take a little bit of a timeout. You just want to see consistency at the top. You don't want to see additional selling pressure. You don't want to see negative news increasing volatility. You just want to see simple consolidation at the top end of a trend. Versus, and when you're looking at the S&P 500 right now, yeah, you have simple consolidation to a certain extent. You went from a high base to a little bit of a pullback, but I would say that is in general some consolidation. You look at that in comparison to what we saw last time that the S&P 500 did that in March. You had a short-term consolidation that led into a little bit of a pullback. Now you have some key differences this time around. Number one, the market never fought for support in that March situation, like ever fought for support. We saw the market fight for support aggressively on Friday this time. So there is some slight differences between the ES and what it went through from a pattern recognition perspective in March versus what it's going through today. But there are some, obvious consistencies there as well. When you come over to the Dow Jones, you're dealing with a little bit more wide range neutrality. And in that wide range neutrality, that has a little bit of a 2,000 point range right now. So there's a lot of different types.
And if you and will you give me small caps as well, because different flavors, but we're all at the consolidation ice cream shop.
Yeah.
Right. Like, some different looks in these different indices, but it, it might be vanilla, it might be chocolate, it might be raspberry swirl.
There are all some degree of neutrality, neutrality slash, wide range consolidation. But if the consolidation is tight, you're going to see that as a more positive sign than if the consolidation is wide range. And so wide range, I would give the Russell 2000 wide range. I would give obviously the Dow Jones wide range neutrality. I would rank both of those two underneath the S&P 500, given the fact that the S&P has a little bit of a tighter range and you have an increase in support within that range. The NASDAQ, when you are looking at the NASDAQ, I wouldn't even call that neutral right now. I would say you're actually in a short-term bullish uptrend, and you're basically doing a bullish retracement right now. And so the one trend that I would say is in a bullish uptrend from a short-term perspective right now is the NASDAQ. That's why we've been talking about is the tech trade back, because that's the one index that did break the resistance level in the futures versus the S&P just had like a 20-point bump up. And so if you're ranking them right now, you still got to look at the NASDAQ because of the strength in the previous movement. You have some concerns due to the volatility this week, and you have some concerns regarding software versus semis. But in general, the NASDAQ does have it's the only index that actually has a trend right now. Every other index is some degree of neutrality. Doesn't mean that the Dow Jones doesn't bounce pretty aggressively off that neutral support level, but the NASDAQ is the one that does have a trend. So it's the one where you're looking at it from a pullback perspective.
Yeah, now want to talk about catalysts that could break us out. We'll do that in about 5 to 10 minutes or so. But what I want to discuss before that is, within neutrality, it doesn't mean that every stock is a winner or a loser, right? Like, I mean, they're not all the same. Excuse
It's
me.
stock,
There are winners
yeah,
and
stock.
there are losers. There are different fundamental drivers during that, and I want to talk about that software versus semiconductor, uh, you know, story, which is, one of those things that is a developing theme. It's a new theme. It's a new narrative. It's a new discussion. And those kind of discussions, if you catch them early, can go a long way in, well, how you position your portfolio, where you're looking for trades and so forth. And so, Matt, break this down, on a very basic, hey, I'm an idiot, what is the basis of it? And then we'll go from there.
Well, when you're looking at a sector, a sector is basically when you're looking at the market in general, and you're talking about the top-down approach to the market, it goes market indexes to assess what your bias is towards the entire market, and you always want
Which
your
is
portfolio.
market index, the SPY,
Yeah,
the Qs,
everything.
S&P 500, NASDAQ 100.
Yeah, and so you're always looking at the indexes to determine your overall market bias, because you want your portfolio bias to always be matching your market bias, and so that's why we always track the indexes. Underneath the indexes, you have sectors that are basically a collection of different industries and a collection of different like-minded stocks that represent a specific area of that sector or the market. So you have 11 different sectors out there, and the sectors are aggressive, defensive, as well as cyclical. You got 3 aggressive sectors, 4 defensive, and 4 cyclical sectors. Underneath the sectors, you have industries. Now, we analyze the indexes every day. We analyze the sectors every single week. We rank the indexes. We rank the sectors. We don't rank industries. There's 110 different industries within the S&P 500. And so when you're looking at industries, you're never asked to know what the technical trends of every industry is. You're never asked to evaluate the industries on a day in, day out basis. You oftentimes don't even have industry conversations on a week out, week in basis. But the reality is sometimes you see these battles that happen underneath the surface a little bit. And we are seeing one of those battles this week within technology. And why that's so important is technology, when technology leads the market, there's no other better bullish uptrend in the market than when technology leads the marketplace. Yes, the trend from November to February in the last 8 months, that was cyclical driven, and that was beautiful, and that was something that we haven't seen historically. I'm not sure we're going to see that many times in the future either. And so you typically get the best bullish conditions when technology is leading the charge. And so over the last couple of weeks, there's been this general question: is the tech trade back? And if you'll recall, the tech trade, which has been dominant many, 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 many times, when you look at the tech trade has not done much since really kind of February, March, when we did go through that general consolidation. But ever since kind of the beginning of May, technology has been the number one sector in the marketplace. It's technology that is really the only trend from a short-term trending perspective that has a higher high, higher low. And so when you're talking about that tech trade right now, and the volatility we saw this week was due to the tech areas of the market, I wanted to look at the industries in technology to see what is really going on here. And so when you're looking at the heat map, for example, and you just kind of look at technology from a heat map perspective, and you look at it from a 1-week performance. All right, so you have software companies that got absolutely smoked.
So we are looking at the performance for the last week.
Yes, for the last week. We're discussing and looking. So if you're listening, we're just discussing the overall performance. If you're watching on YouTube, we're looking at the heat map, and it represents 1 week. Well, what did we see? We saw a general market that was basically doging this week, slight upward movement in price. Cyclical had a pretty decent week this week. Healthcare was a standout on the downside.
This map would have looked a lot different without the last hour of the
all red. That's why you got to have a healthy dose of respect for those buyers on increasing volume coming in. But what stands out to me is software, both on infrastructure and application. And these are AI conversations, and they're the two industries that is leading AI. You got semiconductors, that is the catalyst of AI. They're building out the AI, and then you have these software components that offer AI solutions. And so, one, you have semiconductors leading the charge, creating the technology, and then you have software components that are utilizing those semiconductor components to build AI applications and software components to sell to other corporations, governments, individual consumers, you name it. And so that's why I find this conversation so fascinating, is because it's technology, it's growth, it's AI, it represents the whole conversation. And that's why I think it's also important to kind of track these two spaces, because either one or two things is going to happen, because I do not believe software can trend in one direction and semiconductors can trend in the other direction.
So that is a big takeaway of yours. You're like, these cannot indefinitely go in the other opposite directions.
You cannot see a consistent bullish uptrend in technology if software is going to trend down and semis is going to trend up, which means either one, semiconductors and the tech trade in general is going to carry the software components back up a little bit, or two, you're going to see that general consolidation, semiconductors come down while software continues to sell down. I just see one of those two components, and that's why it's so important to discuss this. And so last week, and so now we got the lay of the land here. We got semiconductors doing fairly decent. You got software components doing pretty bad right now. Now, what was the catalyst this week to see this separation? The catalyst this week was earnings. And what you saw from an earnings perspective, not across the board, but for the most part, you saw slight beats, slight misses on the raw numbers coming out of the software components, and you saw a slight drops in guidance. And that's what really triggered the massive sell-offs within the software components, is that catalyst stock within software, and that's CRM. And so when you were looking at CRM, and one of the reasons why the Dow had such a good day on Friday was because CRM started coming back. Well, when you look at CRM, I put CRM on the bear quick hits within the newsletter this week because of the drop in guidance. When you track their earnings report, Mark, they had a slight beat on EPS, a slight beat on revenue, and they had a slight drop in forward-looking guidance, and the market sent CRM down 20%, which was the worst day CRM had since literally 2004, like right after they became a publicly traded company. And so you saw that big movement down on CRM. You saw it continue to go down on other software components. MDB, they came out, they dropped forward-looking guidance a little bit. Unipath came out, they dropped forward-looking guidance just a little, actually more than just a little bit. Unipath did. And so you had this earnings story happen in software, where you had a lack of growth from a guidance perspective that sent those companies down. But semiconductor companies, they didn't see that same thing. They're the ones that really responded back up to the top side. And so when you're looking at this space, and I think this is going to be something that I'm going to track very closely over the course of the next little bit, when you're looking at the software components, you had Okta report a negative earnings report. You had MDB, Pathlight, you had CRM, all report negative earnings last week. To offset that, you had Zscaler, ZS, report a positive beat and also an increase in guidance. AI, which is C3, the AI application company, they actually had an increase in guidance. And so it wasn't all negative within the software space. You did have some positives there as well, but CRM just really kind of carried it. So I look at this situation right now, and again, when you're looking at software, they're all volatile, and for the most part, they're down. That's also why when something like AI, the C3 company, when they gap up and hold their gap range, that kind of stands out to me. But when you're looking at the actual semiconductors out there, I'm not seeing that massive volatility, quite frankly. Let's take out their earnings, and let's just take a look at the actual companies here. NVIDIA had one of the strongest earnings reports of the bunch. Taiwan Semiconductor, a bullish uptrend with an increase in support level. Broadcom, choppy, wide range volatility. AMD looks like a bottoming formation, really kind of holding firm. Qualcomm just needs a doji at 200 to giddy up and go. Texas Instruments had a wonderful earnings report, one of their better earnings reports Texas Instruments has had in recent history, and they're going through their first pullback since that positive earnings report. Even Intel trying to fight hard at that $30 number. ARM last week held firm against technology volatility. They have a good little breakout situation going. ADI has a fantastic pullback right now happening in the market. The one flaw in semiconductors last week was Marvell's earnings report that kind of fit the bill on the software side. So I'm looking in general at pullback analysis within the semiconductors, and I'm looking at gap down scenarios in the software components. And the question I have right now is, who wins that battle? Does the pullback in semiconductors confirm here and continue to see technology lead the way, or does the gap down scenarios and obvious future bearish retracements here, if they turn around, does that bring the space down? I find this battle between software components that gap down this week and the technology components that basically formed bullish retracements this week, I find that battle very, very interesting, because if the market priced in all of this guidance and we're seeing the low points on CRM, I kind of feel like technology is going to get resolved to the top side. And so I just wanted to talk about it a little bit in the podcast this week, because I actually think this battle between software and tech and semiconductors within technology is really going to whoever wins that battle here, meaning if CRM and some of those other stocks that gap down like MDB, Unipath, if they start forming bearish retracements and deeper bearish retracements, I kind of feel like that bullish retracement that we're seeing in technology in general, semiconductor specifically, will confirm to the top side. And that's based on the bottom getting carried to the top while the leadership continues. So I find it to be.
And let me summarize here, because I see where you are going with this. All right. So tell me if I'm wrong on this. So we're going to have most likely some pattern development. Well, most likely we will. If the pattern development in the combination of semis and software, they can't diverge here, is positive, that's going to be supportive of tech in general, obviously, and thus the market as a whole.
Yes.
Right. And if they're negative, for example, software rallies, but then forms a bearish retracement, come back down, it could help blow up some of the patterns in semiconductors, which would then be negative for tech and then the market as a whole. So you're kind of centering this battle as kind of the current market battle to give us bigger picture into everything, aren't you?
I am. And
okay.
I'm gonna draw a pattern real quick. And I know you can't see it if you're listening, but Mark, describe it the best you can. So what I see is this, Mark, a very unique situation occur here. That and what I'm looking at is IGV, which is the software ETF. Okay. Obviously bucking what we're seeing in technology. Technology is a bullish uptrend with pullback. IGV is a bearish downtrend, overextended, fighting for the 200-day moving average. A scenario I see technically play out here that could be extremely interesting is if we see that selling behavior, and you can see it on Pathlight, you can not Path, but Unipath, you can see it on CRM, you can see it on MDB, you can see it on the stocks that gap down on earnings this week. But if those companies get pulled up, which happens quite a bit. Go look at Starbucks recently. Starbucks had a terrible report, gap down, and it looks like it priced in the entire report, because ever since then it's going up. And so when you're looking at IGV, the ETF that tracks kind of software components, you could see a scenario where you're overextended to the downside, you fill that gap, and then you get into what's known as bear stop out analysis, where you form that deeper bearish retracement, and then once it breaks out of that deeper bearish retracement, which I would call 82, all of a sudden you're no longer bearish there. Well, if that occurs in software, that bearish retracement that I'm talking about, if that bearish retracement occurs in software, I would be shocked if the semiconductors are not in that same time frame kissing up against that overhead resistance level as well. And so what you could see here is a scenario over the next 2, 3, 4 trading sessions where software components form bearish retracements and get into that, those moving averages coming down, and you start having that bear stop out conversation simultaneously as the semiconductors and technology come right back into resistance. And then that scenario would be software breaks out of the bearish retracement pattern, which would be a bear stop out. That simultaneously looks at the semiconductors breaking out, and that pattern realigns the space. And if that occurs, technology is going to lead the market over the next few months. And so, yeah, is it a guarantee to occur? No, but it is a scenario that I feel is not a low delta probability, because the space is going to get realigned. If we're going to see a trend, a consistent trend, the space has to get realigned. And so if that pattern occurs, once again, over the next 2 to 3 days, bullish breakout scenario within semiconductors and technology, deeper bearish retracement, including bear stop out analysis on the software components that got smoked this week. That's a propelling bullish case for the semiconductors. Not necessarily software. The software wouldn't be leading that, but that's a bullish scenario for semiconductors that are.
But it creates a stability in software
patterns in the last couple months that are actually tradable. So I wanted to put it on the radar this week, because I feel this is one of those conversations that is not happening out there in the market, but I feel it's extremely important for the health of this potential trend that we could be seeing develop here.
Yeah, and so it does put on the CRMs of the world, software general ETFs, probably the best way to track this, right? Because an individual stock can go all haywire, and it doesn't change if everything else is.
Well, I would say that about every other software company except CRM. If you wanted to look at CRM, I kind of feel like the other software components are going to go as this gap fill goes on CRM. And when you're looking at the gap, last week in the coaches show, I talked about gaps regarding earnings. In the coaches show last week, in the coaches show this week, I'm doing two back-to-back educational settings on understanding earnings, understanding gaps, and understanding what can happen there. Well, one thing on CRM, if you look at that gap to the downside, where did it gap down into on CRM? It gapped down into the 200 weekly moving average, which is a massively important pivot zone. And so you could see some very good scenarios. And by the way, CRM's earnings report was not terrible. It was a beat on EPS. It was a beat on revenue, slight beats, but it was a beat nonetheless on EPS and revenue. And the guidance dropped was only slight as well. And so the market was obviously very sensitive to this growth conversation. Did they overshoot on the gap? Well, you look at kind of the response 2 days after the gap, and you got to suggest that gap fills based on what we're seeing from a current momentum. So if CRM's gap fills, you're talking about semiconductors leading that, in my estimation, because I just don't feel software is going to fill these gaps unless semiconductors lead the charge. I don't feel like technology can run from a consistent trend unless you see improving conditions in the software components with confirmation on semiconductors. And so it's a little bit of a weird multiple time frame conversation and realignment, but I do see a scenario where tech can lead the charge here.
Yeah, I know that's great analysis. It's unique analysis. You're not going to find that anywhere else. And CRM software, monitor it. It obviously can impact a lot of other things.
Because the polar opposite can occur here too. What if these software components turn back down to start the week and don't form those deeper bearish retracements? And we see semiconductors, turn around a little bit. The polar opposite, because my philosophy here is not that software has to realign on the bull side with semiconductors. My philosophy is if the market in technology is going to trend consistently, it has to get realigned, if that makes sense.
It does. It does. Uh, interesting. Like this is thought provoking for me, and I am very experienced around these things. This is great analysis, Matt. Well done. Well done. In the midst of following that, right? We're heading into the coming week, Matt. Software stabilizing can provide some good tech trades, right? The semiconductor software analysis. I still have it swirling around in my head right now. Like, all right, so what do I need to do to add to my watch list?
I don't think, well, if you're adding anything to your watch list, you're not adding CRM, because CRM.
No, when I and let me be clear. When I say add to my watch list, I don't always trade everything on my watch list. Sometimes I put things on my watch list so I can monitor them. Right.
If there's two things, I would monitor the IGV software ETF, but I do think CRM is the leader in this conversation, and software is going to go as CRM goes here. So I do think you can track CRM in that situation. If there's one company in that software conversation that stood out in that drop in volatility, AI here, C3.com. They had a beat on EPS. It was expected to come in at a negative 30, came in at a negative 11 cents. They had a beat on revenue. The revenue's, it's a smaller company. They had a beat on EPS, beat on revenue, and they increased guidance, which when a company in software, when you're looking at everything that happened in software this week, and a company like C3, which is one of those AI companies that is a like pure AI growth play, I'd get AI on a watch list, both to track the AI conversation, number one, because they are a pure AI play, and number two, they bucked that earnings trend from a negative earnings report, negative earnings reaction in software this week. They gapped up, ran away from the gap, and then basically the next day they saw upward movement in price. And so that looks pretty good. So if there's one company I would put on a watch list, if you didn't have on it, it would be AI, the C3.com, which does look like an improving condition coming from a little bit of a lower point on the chart.
And Delta traders are going to look at AI for setups. That thing is a fantastic cash flow stock.
Oh, it's got the volatility and the liquidity you like.
Like if you're willing to go to war with a stock like AI, and when I say go to war, it means like, listen, you sit through some volatility. That thing in naked puts is just like it is. You're not going to find very many stocks better. Anything that's better in volatility is probably something you don't want to sell a naked put on.
And I could certainly understand, C3 is one of those companies that has a lot of volatility to it. So you're going to get a lot of your premium up front, but you're going to have to deal with the volatility of that. There's no doubt about that. If you are looking at C3 this week from a potential delta perspective, high base at 30. I would love that.
Yeah, no, and if you're from a cash flow perspective, let me lob a naked put, see how that works out.
If you've never done a naked put, do not start your naked put career on.
Yeah, dude. Yeah, if you've never done a naked put, this is not the stock for you.
You don't start here. You don't start here. Stock went from 24 to 30 last week, guys. That's not where you start. No.
You find something boring to be like, how does the sauna feel? Do I like this? Do I like this? No. Matt, before we get into some of the macro stuff, I want to take a moment to highlight the option success training that we have coming up the next first 2 days of the week on, let's see, what does that mean? June 3rd and 4th. Just talk for a second about the option success training, what it is, who can participate, a little bit about that, and then we'll get into some macro conversation.
Yeah, the option success training, which is our introductory course at Tackle Trading that all of our new pro members, we like to have them attend so that they can have a deep understanding of technical analysis, trends, patterns, support, resistance. Obviously, we talk about technical analysis a tremendous amount of tackle trading. You're also going to be focusing on trading options in that course as well. Coach Gino, who teaches the option success training quite a bit, I'll teach it as well, but Coach Gino teaches the live component. I did the on-demand, so you're definitely going to get 6 hours of me teaching that on demand. But Coach Gino does a wonderful job on the live side of the equation. And on June 3rd and 4th, which is this Monday and Tuesday, you're going to have an opportunity to be learning live in that environment. And what we love about the option success training is this is a course that easily could be considered a premium product to tackle trading. It is amazing education. You go from knowing, you could go from knowing absolutely nothing to having a deep understanding of technical analysis, the beginning levels of trading options, strike prices, the option chain, calls, puts, buying calls, buying puts, selling calls in covered calls. We covered a lot of ground here because we want to give you a proper foundation in understanding all of the conversations you're going to have on a day in, day out basis as you are with us at Tackle Trading. So it's a free training for all the pro members. So if you're a pro member, just go ahead and hit that register here button on the landing page. And if you are not a pro member, you can always sign up to become a pro member by hitting the register now button. And as you can see, or as you are hearing, that 15-day free trial is absolutely free. So you can attend the course for absolutely free as well. And then we have a great confidence that you'll stay as a pro member of Tackle Trading once you do. But if you don't, no harm, no foul. You got some great education. You improved your skill set along the way as well. So and by the way, pro members can attend that course as many times as they want. We do
many times as you want.
And the reason I bring that up is I did get asked a couple of questions this week from pro members regarding, I already attended it. Can I attend it again? Yes, we do not do that to our pro member community. Once you're a part of our community, you're just part of our community. So you can attend it once, twice, thrice, or as many times as you want. But the next one is on this coming Monday and Tuesday with Coach Gino.
Yeah, absolutely. It's a fantastic course. It is absolutely foundational type material that there's not going to be a trader around this. Like, why didn't I have that when I started? It would have accelerated the process.
We've had hundreds of students go through the option success training, and no point have we ever had a bad review of that training.
Yeah,
and that is our beginner level stuff. That, like, we've never had a negative review, because the education in that stuff is above reproach. It is amazing education. And that's what we focus on at Tackle. We're not here to sell. We are here to educate. That's our number one priority, and you're going to love it.
Yeah, absolutely. Matt, in the newsletter this weekend, that centerpiece of our pro membership, I write the economic section. And I think I sarcastically said 2 weeks that nobody will remember for the last 2 weeks of the economic. I mean, we've had stuff, but my main gist and point is we haven't had anything narratively change, nor anything that won't immediately be forgotten on the next data point type stuff. This last week, we had the inflationary data come out on the PCE. We had some economic data come out this week that was mixed. The PCE report came in line. Am I being too roll my eyes in the back of my head right now, or would you agree with that general analysis?
Yeah, I agree with the general analysis. I think the economic environment is very similar to the technical environment in the sense that I do believe if you have a bias to the bull side, you can paint a pretty compelling picture from a technical perspective, and you can paint I want to say a very compelling economic backdrop, but you can paint a pretty decent one, especially if you do comparison analysis between the U.S. economy and other economies out there.
You can make a case.
You can make a case easily. You can make a case, but you can also make a case on the other side of the equation as well. And so I do see the economic environment being mixed right now, and I don't think that's going to change anytime soon. I don't see the scenarios where, well, let me put it like this. There is way too much money in our system to see too many negative economic situations. But a lot of the economic data that we are seeing in the last few weeks is mixed, but it leads to what I would describe as stagflation.
Man, I was told that you don't see the stag or the flation out there.
And I told Jay Powell on that day that he have a second go around to that. Jay
Oh
Powell,
my gosh. Like, you know why that was such a, I just got to go. Listen, I'm going to derail it for just 60, 90 seconds or so. That was such a terrible quote on his because it was so memorable. Like, because here I am doing a podcast, what, a month later, and it just pops in my head. I don't see the staggered inflation. Like,
because it's on his tombstone the same way transitory is at this
I don't
point.
see the stagger inflation. What?
It was a terrible comment. It was a terrible comment. He was trying to be cute in a question during the press conference portion of his last monetary policy statement, and he made the comment that on when he was asked regarding stagflation, he said, "I don't see the stag nor the inflation." And myself and many other people are like, "Really, pal?
Really?
Really?" And over the last 4 weeks of data, that's what we've seen. PC report came in line, CPI report coming into the mid threes. Inflation's getting sticky right around that 3%, as we've been discussing over the last 6 months or so. And what are we seeing economically? We're seeing slight drifts down economically, where we're seeing slight drifts up inflationary wise. And so I think I'm going to give Powell another public opportunity to take back his statement. I don't think, even if he did try to take it back right now, I still think it's on his tombstone. So just another terrible misstep from a messaging perspective. And messaging is important at the central bank. From a messaging perspective, that was an absolutely horrific comment to make.
It was just dumb.
Lacked understanding of what stagflation was, and he took the radical examples of stagflation to basically justify the non-stagflation in the US. And I don't see the radical situations of stagflation setting in. I don't see 10% unemployment with a massive move up in inflation. I don't see 10% unemployment with 10% inflationary pressure, as Powell indicated. But you also don't need to see 10% inflation.
Yes, pal, we are not in the Great Depression. Thank you for pointing that out.
Exactly. Nobody, even the people that are looking at the economy and saying this is a house of cards, they're not saying it's Great Depression. So he tried to use, and I see this politically happen a lot, and the central bank is certainly getting more political, but I see it happen a lot where they use the most radical case study to do cross comparison analysis to make it seem like the current condition is not nearly as bad or nearly as good as what their worst or best case scenario historically is. And I thought it was an easy call out of Powell to say that was nonsense, because it was nonsense. And over the last 4 weeks since he said that comment, guess what? We've seen a pop in economic value, and we're seeing a bump up in inflation. And so Powell, like, just, bro, you got to work on that messaging. That was a terrible, terrible moment. And it was so bad that people like me immediately started thinking transitory. That's how bad it was. And so, yeah, but that's also what we're seeing. Like, for example, consumer confidence slight up this week, retail slight up this week, GDP slight down. And so home sales slight down, manufacturing data slight down. And so it's a very mixed economic
Chicago
backdrop.
PMI, total abysmal train wreck.
Well, yeah, but that's the Chicago PMI. But it does. You've seen some positive PMI numbers like we saw last week. You saw New York PMI and Chicago PMI crater. So it's a mixed bag out there right now. But again,
and that's what it's like. And when I say it's 2 weeks to be forgotten, when it is a mixed bag, it's hard to form a narrative.
That's a great point. But go on that for a second, because I think that's
because so when someone like me who lives this stuff, who tends to be a little eye rolling, sarcastic, and all that, it's like you are looking for narratives, things that are easy to understand or things that are absolutely correct. For example, one of the best ones in recent years is coming into 2023. What was everyone talking about, Matt?
The end of the world.
The end of the world, recession was coming, interest rate lag effects were going to kick in.
I don't think there's ever been a moment where I saw so many people, and this is coming out of the 22 market that was bad, right? And this was right when they were starting to raise interest rates while the market was already going down. And so it's understandable that people had that opinion.
It was the wide consensus. And I will give my brother credit to the day I died. he was like, no, this is wrong.
They were wrong.
Like, I do not see this in the data, right?
Yeah.
I do not see this in the data. And he was right. He was dead right. And I'm talking a lot of very smart people
this is true.
and they were wrong.
They were wrong. Historically.
They were historically wrong. And so, okay, so let's get back to this, these last couple of weeks, just roll your eyes and none of it matters, because sometimes economic reports don't matter. Oftentimes they don't matter because they are just reinforcing what we already know, right? If things are going well and you have a good report, well, that report doesn't really matter because it's just reinforcing things.
Yeah.
Or like we've had lately, when things are maybe a little mixed, they're just all counterbalancing one another. So they don't really matter because they don't form new narratives. But economic reports have the potential to form a new narrative. So coming into 2023, we're going to just have this recession and interest rate lag effects and just all this negativity. And then the February jobs report comes out. And it is a smasher, not just adding jobs, but something like expectations of 170. And I might be off on my numbers here.
I got it right here on your screen. It's expectations of 193.
So it goes 517. Yeah, okay. So, and so you come in this negativity and just say, what's up? What's up? We're not going to be having a recession anytime soon if the economy is adding jobs at that pace. And that report set off a major theme in 2023. You went from recession to economy strong, no landing, created a lot of bullish momentum in certain areas of the market. In fact, the catalyst was so strong that it set off in the 4 or 5 months later, the dollar and yields taking off because things were too strong.
It was the report that made everybody be like, the labor market's way too strong. We got to recalibrate two things on that report. We need to recalibrate the economy is going to die this year, and we need to recalibrate how many interest rate cuts we're going to get.
Yep.
And that set that stage for the exact same conversations we've been having ever since that time.
And so, like, even if you, like, one of the reasons that you should listen to this podcast every week is because you will not miss the major moments in macro turning. You won't miss it. Matt and I will nail it. Like, we will. And we'll also tell you there's not a lot to see like in the last couple of weeks. Right? It's another reason to read the newsletter as a pro member, right? It might not be exciting to see, none of this mattered the last couple of weeks, but that's the correct analysis. That's the correct analysis.
There hasn't been one data point in the last 2 weeks that changed any narrative. That's the reality. Everything was slight beat, slight miss, not that important. Because you're having an interest rate conversation, which means it's going to be major reports that have the ability to unify the market participants, right? When things are mixed, we all have our cognitive bias. When things are mixed, we will parse the data as the way oftentimes which fits our own personal narrative to a certain extent.
Man, we got to be careful with that.
That's cognitive bias. We have to be very careful with
careful with that because, and we talked a little bit about this last week with the poll, like, do you see a recession, right? Like, you got to be careful of that because you can't let that influence your decision making.
No, you understand your biases so that you can protect against them, not so that you can enhance them. Biases are typically a negative for you as a participant within the financial world. But when you're looking at a mixed market technically, a mixed market economically right now, a trader's market within individual sectors. I mean, we're not even having a sector rotation conversation this week. We had an industry conversation this week. That's how mixed we are right now in the marketplace. Obviously, software versus semiconductors are one of the more radical examples of that mixed market, but we are going through a mixed market right now. And so the catalyst, like you were talking about with the labor market numbers in early 23, kind of changing that overriding recessionary conversation to be like, no, this is just an inflation conversation, not an economically recession plus inflation conversation. This week, what are the economic reports you're looking at this week to maybe unify the market economically? Because if you're unified the market economically, you'll have a much better understanding on that interest rate conversation and where the market wants to go. So what are those reports this week you're looking at?
Yeah, I mean, listen, so this is the week we call unemployment week, and we call it unemployment week because of the monthly report that is issued on the first Friday of every month. Every once in a while, the first Friday will fall on a first, and for whatever reason, they'll do it on the 8th, but just pretty much it's the first Friday every month. And there's a lot of monthly economic reports related to unemployment that come out before that. From a narrative standpoint, all of those other reports don't matter. They're cute window dressing leading up to the monthly report. I've never seen the long lasting because Joel said something. Did you know? It will create action that day.
An interday thing, yeah.
Yeah, it will create action that day, right? It can lead to.
Will create action this week.
Yeah, absolutely. You are in a week with a lot going on, right?
Is it real quick, and before you go off on which ones are the most important for you this week, would you also suggest that given the sensitivity that the market has shown to reports recently, as well as the slight increase in volatility we've seen this previous week, do you feel like the market is on a little bit of edge here and you might see a little bit of additional volatility this week just because how sensitive the market has been to the rate conversation recently?
Yeah, and that is an excellent point because you go through these time periods where you have lots of data come out and the market doesn't react to it at all. In fact, market pundits will sometimes say, "What, does the market not care about anything right now? How can it not react to the?" But it's just not sensitive, and that is a great word for it. Sometimes the market is not sensitive to economic data. Because maybe there's an overriding narrative somewhere else that's driving for whatever reason, right? But when you start to see, Matt, rate cut expectations have been pretty wild lately.
Yeah.
Right. They've went up, they've went down. They've been all around. And market reaction has been sensitive, right? We've seen PMI numbers come in hot. And the market wildly reacted. That doesn't happen every day. That doesn't happen every day, right? NVIDIA comes out with great earnings, Matt. PMI comes in hot. Interest rate cut expectations go down, not this like 9 days ago. And market sells off huge. Market sells off huge, right? So there is an extra sensitivity out there right now in the market. And so realize that until you see that come down, realize the intraday swings are probably going to be a little wilder than they normally are, and just be prepared for that.
For example, the manufacturing PMI numbers come out this week on Monday. They're the first major report to come out this week. I'm not saying that that's not an important conversation. I think it is an important conversation. And you'll probably see some additional volatility around that PMI number. I also think by the time we're talking about the JOLTS report on Tuesday, we're done talking about the
PMI. And that is as a left brain nerd, Matt, how do you process that? Because that's the truth. I know that's the truth. How do you process that? Do you just accept it like that's just reality?
I have an expectation that we're going to see more volatility this week than we typically would in this week. I do have that expectation this week, and that's based on two things. Number one, the slight bump up in volatility in general, but I've seen recently, not just recently, but in the last year and a half, anytime the market is having that moment of doubt on whether or not they're going to get their cuts. Because if there's one thing the market wants more than a rate cut, I'm not sure what it is. They've been begging for it for a long time, and they've been disappointed for a long time. And when they get in those moments where the data does not support the Fed cutting rates, which means we get into a rate sensitive conversation, I've just seen the even minor economic reports get priced in like major economic reports. And so we are having one of those moments where yields are slightly bumping up, showing a little bit of reversal situation. The dollar showing a little bit of a reversal situation. You know, we're having one of those conversations on will we not get a rate cut this year? And so this data, when we're having that conversation of will we or will we not get a rate cut this year, has the tendency to be a little bit more important in those moments than they otherwise would if we were not having that rate sensitive conversation. And so I certainly do think that's going to be the case this week. So it's kind of built into my expectations. Number one, that we will have a little bit more volatility, but I don't see that as necessarily as a negative thing, because for the market to break out of its neutrality, you got to have a pickup in volatility to see that. So it's kind of built into my expectation this week that we will have a little bit bigger volatility. But that's also one of the reasons Coach Greg wrote about the straddle and the strangle regarding in the traders report this week, is to, I think all of our expectations is a slight bump up in volatility. And if you have a slight bump in volatility, that's going to do two things. Number one, two things on the positive side. Number one, it's going to enhance theta strategies, because the slight bump in volatility allows you to sell options for a greater premium. And number two, it enhances the viability of bidirectional strategies, which we're about 6 weeks in front of the next earnings season, Mark. This is kind of one of those opportune times when you expect a bump up in volatility due to these economic reports this week and the sensitivity to the market this week. Plus, when you're looking at just that standard earnings volatility cycle, which I'm going to be teaching to the pro members during the coaches show this week on Tuesday. So if you're a pro member, get excited for that. But I'm going to be teaching how that volatility cycle is very consistent as due to earnings. And so you have an expectation that volatility is going to bump up due to the sensitivity of the earnings of the economic environment in relationship to the yield conversation. And you have an expectation that volatility is going to bump up simply due to the earnings cycle and how volatility goes up and down based on the earnings cycle. And so bidirectional opportunities come into play a little bit as well. And then if you do get volatility to enhance, but it's on the consistent side of the equation, that starts bringing in the delta conversation as we start to break out of this short-term consolidation, and that could be up or down. And so, yeah, I do think it's built into my expectation of volatility increase this week, which is going to open the door for a little bit more bidirectional strategies. I also think increasing volatility this week, depending on the consistency of that volatility, we could see a breakout against the market one way or the other this week, which certainly would be a tradable situation, whether you're either increasing your delta based on a breakout to the top side or reducing your delta on a breakdown to the down to the bottom side. So my left brain nerd just honestly, it just processes my expectations, and then it tells me kind of what types of strategies early in the week that we're looking at a little bit more than at the end of the week. Because at the
difference between these two brothers is Matt goes through a concrete analysis on all that, and I'm like, there's gonna be a lot of noise. There's gonna be a lot of noise.
There is that, but that noise increases volatility, and that increase in volatility helps option trades on the directional side.
It does. And then you got the unemployment report on Friday, Matt, and then the next week you have CPI and Fed meeting the same day on Wednesday, followed by a PPI on Thursday. And so a lot of noise Monday, Tuesday, Wednesday, Thursday. That's increased volatility on that but then you get into this little mini event Friday through Wednesday with unemployment, CPI, and Fed meeting all within a 4-day span.
All right, question. Are we still in consolidation after the next 2 weeks of pretty much every economic report of importance?
Like everything comes out, like Boy, that requires what happens. Some version of consolidation.
Mhm.
I'm going to bet yes.
Are we still between 5,200 and 5,350 on the S&P?
Oh no, that's a tight range.
It is? But
No, we're not.
That's the consolidation.
We're not. No. That's too tight a range. That's too tight a range. We've either broken out or we're heading down below. Yeah, that's too tight a range. Is the Dow still in consolidation? Yes.
I think the Dow is still in consolidation. I think the Russell is still in consolidation.
I think those are the S&P is not.
But the NASDAQ and the S&P, they're just in better positioning to see continuation of trend analysis. So I think it's going to be a choppy ride. I do.
Yeah, I don't think we have like the all answer everything in the next 2 weeks, but that's too tight a range. You're breaking out of that one way or another.
The only way we're getting the answer to the all everything is if the inflationary reports plus the labor market gives the Fed the ammunition to start cutting before December.
Yes. So if you get, yes. And then, well, maybe the Dow and everything breaks out in that like party everything little stretch that you might have. But yeah, but we'll break that all down. Matt, let's finish up as we always do, talking broader markets. And we don't always finish up. Sometimes we just start with freaking gold and the dollar because that's where the story is. But we got a lot of consolidation of some version in oil, in gold, in even the high flyers in silver and copper
right now.
You know, some different type of like volatility, shifting volatility at the top of the chart. So there's not a lot of like, I don't know what's the right word. Like, oh my God, I got to go do something right now. Unless I have an existing trade, maybe I have to manage it on silver or copper or something like that. But you know, talk about what you're seeing in these charts.
Well, we'll start on the dollar. When you are looking at DXY here, you know, it's one of those situations.
Oh, and the dollar will not be in this consolidation range 2 weeks from now.
The dollar could be far out of this consolidation.
Yeah, it is not going to be in that consolidation range.
No, I fully expect the dollar to really kind of set the tone as we're going through this conversation in the next couple of weeks. Keep an eye on 105.12. That's kind of the 50-period moving average on the daily chart. If you're above that level, we are not breaking out on the S&P 500. And if you break and close underneath the 200-day moving average on DXY, we're probably breaking out there. But it's very sensitive on the currency right now. On gold, when you're looking at gold right now, I think if there's one thing to keep an eye on gold, it's the double-pronged area of support right now. You got the 50-period moving average on the daily chart right underneath the price of gold. On the weekly chart, it is kissing off the 9 EMA on the weekly, which has been providing a support level for gold analysis pretty much consecutively for the last little bit. And so it looks good, but you're in just consolidation here on gold. You're just sitting at some pretty important support levels. And so you're going to want to track that combination 50 on the daily, the 9 on the weekly. GDX is in one of those situations where GDX, the gold miners, does look better than gold itself does, and certainly can play catch up as it has in this current trend. You're sitting at a level that I would keep an eye on. 35 in GDX is going to be really, really important. Secondarily, the 50-period moving average right underneath GDX would be really, really important. There's a couple good-looking gold stocks from a directional perspective right now. So if we see a break back up above 36 on GDX, and that's the number I would anchor against, I'd keep an eye on that, because GDX can trend in a slightly bullish condition while gold goes through general consolidation. And if the gold support levels hold, despite the fact that it would not change our overall bias on gold, we would have that anticipation that gold goes back up into resistance. And just that alone would propel gold stocks to go up a little bit as well. So I don't see a scenario where you got a tradable setup on gold, although it's another day that ends in Y and you're setting at a support level. Everybody knows the end conclusion of that sentence. But if that support
let me finish it, because we get new viewers, believe it or not. Yeah. We are of the thing, if you do not own gold, any day that Y is, regardless of technicals, regardless of whatever, it's a good day to add some gold to your portfolio.
Yes. Now, if you're maxed out on gold, you're just writing covered calls right now. But in GDX, I do see a scenario where if that support level in gold holds, then B, we hold on 35. If you see confirm above 36 on GDX, you do got a confirmation on a bullish bull flag based situation. So I still got a slightly bullish read on gold, despite a little bit of a short-term neutral read a short-term neutral read on gold versus a slight bullish read on GDX. Silver was an interesting situation last week. This is the number one momentum place of the commodity areas of the market. That bull flag was really, really, really good, and it had a fantastic day on Monday. It just came right up into resistance and faded down the rest of the week, but it did not violate that support pivot. And so it's going to be a really interesting situation on silver. I do not see a new situation happening on silver right now, given the fact that the short-term situation is wide. I don't want to say wide range. I want to say increasing volatility at the top end of a trend that looks stinking close to an M formation. I want to see that get played out, which means the next trade setup, if you're not already involved in this trend, and I think a lot of people at Tackle Trading are certainly already involved, but as of right now, I do think the next trade setup is either working back up into resistance or a deeper pullback, which basically kills the previous trend and we get into reversal analysis. Either way, that's probably a next week or a week after conversation. When you're looking at some of the other metals out there, copper had a little bit of volatility in the last couple weeks. One key point, though, it had a kiss to the penny off that 9 EMA on the weekly chart. That looks pretty good. Put it in King's Bed reversal analysis on copper. If we do hold that 9 EMA, a nice little reversal on the daily chart would go a long, long, long way to clean that space up. When you're looking kind of at the overriding crude oil market right now, I don't really have an update. In the newsletter, we basically called it the battle of the 200s here. You got the 200 daily moving average acting as resistance on the top side. You got the 200 weekly moving average acting as support on the downside. We're going to have to wait to see who wins that battle. So we're waiting on confirmation one way or the other on that side of the equation. And then last sermon.
Yeah, one thing to note on oil, by the time you listen to this podcast, or maybe shortly thereafter, OPEC will have met. OPEC will have met, and obviously that's the equivalent of a Fed meeting in the oil space, and certainly can provide some interesting, some interest.
It can provide some volatility, which can certainly provide a catalyst, which might break oil out of its short-term slumber. On Bitcoin, wide range neutrality, but an increase in support against that wide range neutrality. Talked about that last week here in the pod. Still looking at the same thing. Had a little bit of a downward pressure on price on Friday, despite the market looking pretty good on Friday, but it did not break that 38 level. Still looking pretty good on that. Front running opportunity going into 42 potential breakout on IBIT. Wanted to rapid fire the commodities as we always do there, Chucky.
Yeah, well, thank you. I always enjoy doing the podcast with you, good sir. Any final thoughts as we wrap up?
Oh, no, I had plenty of thoughts in the pod today.
Yeah, it was listen, that was a lively podcast. I thought it was, I enjoyed it, I enjoyed it. And I feel better prepared. I feel better prepared for the week ahead. Listen, we love our community. We continue to try to create products for you, analysis for you, whether it is for individuals in our pro community, the newsletter, check it out. Like, seriously, you will just be as prepared as better than 99.9999% of the people out there on planet Earth for financial markets if you read that newsletter. But here on the podcast as well, the different programs we do for people that don't pay us anything to support us on that. We try to do the best. We just really appreciate you. We really appreciate you. Those are my final thoughts. But we'll be back next week. 582. Going to definitely track that software patterns this week. That's for sure. But have a fantastic week, everyone.
Later, Tim.